What's the difference between winning and losing in options trading? Most traders miss it, the timing. So in this video, I'm going to show you the exact entry and exit method that I use to win more trades, tailored for every style from super conservative to super aggressive. So you know when you're driving to the mall and you're trying to find parking, some people choose to park way on the outskirts where there are no other cars and walk it in. Why? Because they will 100% find a spot to park. It will be simple for them to get their vehicle in between the lines. And for most people who choose this strategy, it's just easier. That's kind of like what the super conservative strategy is like when it comes to selling options. You are selling puts or selling covered calls with incredible odds, often 80 to 90% in your favor, which means the chances of having to buy 100 shares when selling a put or selling 100 shares when selling a covered call are very, very low. The obvious pro of this is the high win rate due to the low amount of risk. But this lack of risk comes with the trade-off of not making as much money, likely only 0.5% or less as a return on your cash, compared to the aggressive or super aggressive methods which are to come. Think about it. When you park your car that far away from the store, the trade-off for that guaranteed spot is having to walk a further distance. Now, this can be a great way for beginner options traders to get started because of the high odds of success. If you want to win more of your options trades, subscribe to my channel now and then follow these key tips. When selecting a strike price to enter your option trade at, use the delta in your options chain to guide you. Delta is a measure that tells you the probability of winning the trade. When you look for strike prices with a delta of 10 or less, it gives you a 90% chance of winning every trade you make. You can take it one step further and see if that 10 delta strike price lines up with a key technical support level on the stock chart. If there's a price point that the stock has bounced off of several times and moved higher, this should give you added confidence when selling a put. And if there's a top end price that the market keeps rejecting lower off of that matches with your delta value on the call side, this is a great spot potentially for a highly successful covered call. Now that you know how to enter, let me show you how to exit the right way so you don't end up capping your gains. When selling super conservative option contracts, you will need to wait patiently for time to go by. Once a trade shows a 90% unrealized profit, you can close it off and look to make another trade with your capital. That means if you've received premium for selling the contract at $100, you want to try to pocket 90 and pay $10 back to close the trade. Then you'll be free to open a new trade and make more money. Now, if the stock moves against you, which is unlikely but not impossible, a super conservative way of exiting would be to accept the obligation that comes with either selling a put or selling a call. You would sit back, relax, and either automatically buy 100 shares of stock if you sold a put, or sell 100 shares of stock if you sold a call. And once those actions happen, you could then go and sell a covered call on the stock you just purchased, or sell another put option with the cash from your 100 shares that were sold. Ready to take a small step up the risk ladder? Let's see what happens when you get a parking spot a little closer to the mall. Now, with a conservative type of options trading, you are taking on a little bit more risk for a little bit more reward, but still not putting yourself out there too far. Think back to our driving to the mall scenario. Instead of parking on the outskirts, this time you get closer where there are some vehicles around, but far enough away that you can still find a nice pull through spot. A conservative options trader selling puts or calls would be aiming for 75 to 80% win rates. He will be trading a bit of that certainty for some extra cash flow, targeting a 1% return on your money. Trades in this realm are often placed a month out in time and are held for 2 to 3 weeks before closing the trade if it works out, or waiting till expiration if it doesn't. So, how do you enter a conservative options trade? Well, start again with your delta and target the 15 to 25 delta range for your strike prices. I like to combine this with a Bollinger Band technical indicator, which shows the limits of how far a stock's price usually moves up or down. I'm also on the hunt for support and resistance levels where the price has bounced off of at least 2 times. When the stars align and the delta indicators come together and I can get a 1% return on my money, that's when I pull the trigger. Now, when is the best time to close this trade off? Well, again, for me, it's good to have a price target and I use 80% for my conservative trades. If I can make $80 out of 100 in 3 weeks and there's 1 week left, it wouldn't make sense to wait another week for that last $20. I'd rather close the trade early and go find another one where I can make another 80 bucks in 3 weeks or $26 a week instead of waiting for that last week and last $20. For a conservative style trade, I would also accept having to buy 100 shares or selling 100 shares if the trade move against me. This keeps the mechanics simple and allows me to continue to repeat the trade setup as the market moves. You can learn these simple mechanics and trade setups step by step by subscribing to my channel now. Next, you're going to learn how to up your reward with a more aggressive option style trade. If you've ever sped up to the front of a busy mall and tailed someone to their car, hoping for that prime parking spot, you know it's a gamble. You might score that best spot, but you might get nothing if someone else beats you to it, or the person you're following just walks off in a completely different direction. That's the aggressive approach in options trading. More risk, more reward, but again, less certainty. With this style, you're aiming for a 1.5 to 2% return, but your odds of winning drop to 60 to 70%. To set up these trades, look for options with delta between 25 and 35. You can match your strike price with a level on the price chart where the stock has bounced off of once before, even better. And when the trade is working, I like to take profits early at the 50 to 60% of the potential gain. But if the stock moves against you, you need to have a clear exit plan. For example, you might close the trade if the stock drops 5% below your strike price or breaks through a key support level on the stock chart. This type of approach means more prep and more screen time, and some traders even shorten the expiration date to a week or two to keep the action going. But that does mean more trades to manage. So, are you ready to see what happens when you go all in for the biggest rewards? Let's dive into the most aggressive trading style next. A super aggressive entry is like driving right up to the front row of a parking lot and assuming a spot will be waiting for you. If you get it, you're a hero. If not, you're stuck circling the stalls, wasting time, maybe even ending up further away than what you started. In trading, this means selling an option at the current stock price, which is called at the money. You're aiming for a big reward like 2.5 to 3.5% on your money, but your odds of winning drop to a coin flip of about 50 to 60%. There's no fancy chart reading and no delta checks here. You just pick a strike price right at the stock's current level. The risk, you could lose big if the stock moves against you. That's why it's crucial to have a plan. Take profits early, maybe when you've made about 30 to 40% of the potential gain. And if the stock does drop, let's say 10% below your strike price, or if your trade shows a 100% unrealized loss, cut that loss and get out. If you do want to let it hang around or try to repair the trade, you could buy another option contract to protect yourself, or you could roll the trade out in time to a later date and give it more time to work. Now, do you want to know the secret that took me 6 years to learn about all these trading styles? Well, the market is always changing, and you and I possess different skills. So the way that I trade might make sense to you, or you may prefer to do it a different way. It's kind of like putting together your closet of clothes. You have different sweaters, fancy wear hats, and shoes than I do because you like the style or the fit, or there's some other reason for it. And as you learn more about options trading, you'll pick up your own style along the way. If that happens to be selling options, great. Subscribe to my channel, let's dive in it together. But if you find another strategy that fits you better, that's great too. The most important thing is that you are true to yourself. Don't just copy someone else. Take what works, leave what doesn't, and build your knowledge and confidence up over time. And if you want to skip the fluff and get straight into the secrets pro traders use when selling options, watch this video next.